Picture this. You're just about to take the real estate exam, and you are brimming with confidence and ready to conquer. Sounds surreal, right? Well, what if I told you it is within reach? No more second guessing and stressing over unfamiliar terminology. Mastering just essential real estate terms 61 to 90 will help you boost your confidence and ace the real estate exam. It's time to turn that dream into reality. You've got this.
Property manager. Now guess what the first term means. Take a few seconds. A property manager is a professional who takes care of real estate properties for owners. They handle daily tasks like finding new tenants, collecting rent, and maintaining the property. In short, they make life easier for landlords by ensuring smooth operation and upkeeping of rental properties. Next one coming up, active property. Let's see if you can nail this definition. What does active property mean? An active property is a real estate listing that's still on the market and open for offers. When a property is labeled active, it means the seller is still accepting bids, making it a potential opportunity for buyers searching for their perfect home. Moving on, term number 3, co-ownership. Take a few seconds and think about it. Co-ownership is when 2 or more people share ownership of a single property. These co-owners may hold the title as tenants in common, joint tenants, or tenants by the entirety. The type of co-ownership determines the legal rights and responsibilities of each party in relation to the property. Let's jump to the next one, joint tenancy. Take a crack at it. You've got this. Joint tenancy is when multiple people co-own a property. In this arrangement, if one owner passes away, their share of the property automatically transfers to the surviving co-owners. This ensures a smooth transition of ownership without the need for probate or other legal complications. In a nutshell, you should think of joint tenancy as a type of co-ownership. Lease. Let's see if you know what lease means. A lease is a contractual agreement where one party grants the use of property, services, or land to another for a set of period. In exchange, the user typically pays a regular fee. Easy, right? Sandwich lease. Let's see if you can nail this delicious definition. A sandwich lease is a unique rental arrangement where a property owner leases their property to an investor, who then leases it to a tenant. In this scenario, the investor acts as a middleman between the property owner and a tenant. Therefore, the investor is sandwiched between the property owner and the tenant. Now that sandwich time is over, next term activate. Constructive eviction. Time to flex those definition muscles. Take a few seconds and then let's see the definition. Constructive eviction occurs when a landlord's neglect or actions make a rental property uninhabitable, forcing the tenant to leave. This breach of the landlord's legal responsibilities may entitle the tenant to seek legal remedies or terminate the lease agreement altogether. Satisfaction of mortgage. A satisfaction of the mortgage is like a certificate of completion for a mortgage. It's a legal document that shows the mortgage has been paid off, lifting the lender's claim on the property and transferring ownership to the borrower. This document contains essential details about the loan, property, and parties involved, along with proof of authenticity. Let's jump straight to the next one. Amendments. Give this term a shot. An amendment is a modification to an existing contract that updates or alters the original terms, allowing the agreement to better suit the needs of the involved parties. For instance, sales price, closing date, or correcting mistakes. Alright, what's next? Recovery fund. What's this term all about? A recovery fund is a safeguard established by some states' real estate commissions to protect the public from potential misconduct by real estate agents. It acts as an insurance policy, ensuring financial compensation for homeowners and agents affected by fraudulent or harmful actions in real estate transactions. Tenant turnover. Give it your best shot. What's this term about? Tenant turnover is the rate at which renters come and go from a property. It can also refer to the time it takes for a new tenant to move in after the previous one leaves. Principle of substitution. Time to play, guess the term. Take a few seconds and think about it. Buyers won't pay for a property if a similar, cheaper option exists. This principle keeps property prices competitive and reflective of true market value. Here comes another one. The Clean Water Act, CWA. The Clean Water Act, passed in 1972 and amended in 1977 and 1987, is a federal law aimed at controlling pollution in U.S. waterways. It seeks to preserve the quality of water resources by regulating pollutant discharges and protecting wetlands, ensuring clean and safe water for all. Mortgage. Think you've got what a mortgage is? Prove it! A mortgage is a long-term loan deal between a lender and a borrower to purchase a property. The home itself serves as collateral for this secured loan. Mortgages typically last 15, 20, or 30 years, and borrowers can obtain them from various financial institutions to finance their dream homes. Bring on the next term, down payment. A down payment is the initial cash you pay upfront when buying a property, typically ranging from 2% to 20% or more of the purchase price. Lenders often offer lower interest rates for larger down payments. The specific percentage depends on the borrower's circumstances, lender requirements, and the type of mortgage loan chosen. Amenities. There you go, you got this. Amenities are desirable features or extras that enhance a property's appeal and comfort, ultimately adding value to the home. Let's see another one. Inverse condemnation. Give it a go. What does inverse condemnation mean? Inverse condemnation is a legal process allowing property owners to seek compensation from the government when their land or property is taken, used, or damaged for public purposes without fair payment, ensuring their rights are in fact protected. You've got this, you see? Another term on deck. Notice of default. Go ahead, think about it for a couple seconds. A notice of default is a public warning that a lender issues when a borrower falls behind on mortgage payments. Filed in court, It signals that the borrower is in default, allowing the lender to proceed with foreclosure. This notice is the second phase in the foreclosure process, following a borrower's failure to make their mortgage payments on time. Here we go, switching gears to the next word. Underwriting. Ready to take a guess? Let's do this. Underwriting is the lender's process of assessing a borrower's eligibility for a loan. An underwriter analyzes the risk and decides if it's wise for the lender to approve the loan. Don't worry, a simple term is coming your way. Contract. A contract is a legally binding agreement between two or more parties, outlining their rights and obligations. I told you, it's easy. Next up is prime rate. The prime rate is the interest rate banks typically offer to their most creditworthy customers, often used as a basis for determining rates on mortgages, personal loans, and small business loans. This rate is particularly important for calculating interest on variable rate mortgages and other financial products. Rent. I'm sure you know this one. Rent is the regular payment made by a tenant to a landlord, typically on a monthly basis, in exchange for, well, the right to occupy a property. Moving on, income approach. The income approach is an appraisal method that calculates a property's market value based on its potential income generation. Using discounted cash flow analysis, appraisers estimate the property's current value by considering the present worth of future cash flows that the owner can anticipate. In a sense, it's about determining a property's value based on its money-making potential. Principal payment. Guess it if you can. A principal payment is the portion of a loan payment that goes towards reducing the initial borrowed amount. By making principal payments, borrowers can decrease the total debt owed and work towards paying off their loan more quickly. Next one, let's get it. Addendum. An addendum is an addition to a contract or agreement, clarifying or expanding upon the original terms to ensure all parties have a clear understanding. Material defect. Think fast. Do you know what a material defect is? A material defect is a substantial issue with a property that significantly affects its value or poses a considerable risk to the occupants or users of the property. Almost there. Let's crack open the next word. Appurtenance. Take a stab at this strange term's meaning. Go! Appurtenance refers to an item such as a fixture or improvement that is attached to a property and is transferred to the new owner when the property is sold. And the little brother of appurtenance is Appurtenant. Appurtenant describes something that is connected or belongs to another thing, either physically attached or legally bound. It's an adjective that highlights the relationship between two connected elements. For instance, a fancy chandelier or a still water tank. Things that are installed onto the property and will remain even if the property gets sold. Conventional loan. Take a couple of seconds and think this through. A conventional loan is a mortgage provided by private lenders, such as banks or credit unions, without government backing. These loans, available through various lending institutions, typically require good credit and a down payment, offering an alternative to government-backed options like FHA or VA loans. Amortization. Quick, think on your feet. What is amortization? Amortization is the systematic process of paying off a loan in equal installments over a set period. It's an accounting method that gradually reduces the book value of a loan or intangible asset through regular payments, ensuring a consistent and predictable repayment schedule. Negligence. Take a few seconds and think about it. Negligence refers to a situation where an individual fails to fulfill their obligations, resulting in harm or damage. It can essentially be described as a lack of due diligence. For instance, a real estate agent demonstrating negligence might fail to disclose crucial information, such as defects in the property or inaccurate details about its condition, size, features, or value. Here comes another term: estate at will. Estate at will or tenancy at will is a type of rental agreement where both the property owner and the tenant have the freedom to end the agreement at any time. This flexible arrangement doesn't have a fixed expiration date, making it an indefinite tenancy. Keep in mind that not all states acknowledge estate at will, and regulations may vary in those that do. VA loans. Let's see if you know what VA loans means. VA loans are like the superheroes of mortgage loans, specifically designed for our military service members, veterans, and their families. These loans boast better terms than the average mortgage, making them well-deserved financial perks for our heroes. Chattels. Chattels, simply put, are your personal portable belongings. Think furniture, appliances, or even artwork. Unlike real property, these items can easily be relocated from one place to another. Next up on the term train, Chattel Mortgage. Time to flex those definition muscles. Take a few seconds and then let's see the definition. A chattel mortgage is a special type of loan for items that you can move around, like mobile homes, business equipment, or vehicles. The movable assets serve as collateral, meaning they secure the loan and can be seized by the lender if the borrower fails to repay the loan. Time for the next one. An easy one is coming your way. Title. A title is your legal proof of ownership for an asset, such as a property or a vehicle. Safe Drinking Water Act, SDWA. The Safe Drinking Water Act, or SDWA, was created in 1974 to ensure your tap water is clean and healthy. This important legislation empowers the EPA to monitor water quality, enforce limits on contaminants, and penalize any violators. To maintain water safety, regular testing is required, and if issues arise, state officials and residents are promptly informed. So, thanks to the SWA, you can enjoy your glass of water without worrying about hidden surprises. unless you count the occasional lemon wedge. We can't stop, we won't stop. Moving on. Riparian Rights. Give it a shot. Riparian rights grant landowners with property besides a river or stream the privilege to reasonably use that water as it passes through their land. Think fishing, irrigation, or simply enjoying the view. Let's jump straight to the next one. Leverage. What's this term about? Leverage is a strategic approach to investing where you borrow money to fund most of your investment. General agent. A general agent is a trusted individual appointed to act on behalf of a principal in all aspects of a specific business. This professional relationship generally lasts for an extended period, allowing the agent to manage ongoing responsibilities and make decisions in the principal's best interest. All right, what's next? General contractor. Take a few seconds and think about the definition. A general contractor is the go-to professional for overseeing and managing the construction, enhancement, or remodeling of a property or project. A general contractor's responsibilities encompass overseeing various construction aspects, such as managing electrical work, plumbing installations, and structural modifications to ensure the project's timely and efficient completion. Let's go! Here comes another one. Bilateral contract. Think you've got what a bilateral contract is? Well, let's see. A bilateral contract is your everyday agreement between two or more individuals or entities. Think of it as the bread and butter of contracts, as it encompasses most business and personal deals. Just remember, in a bilateral contract, it takes two to tango, or more in some cases. Bring on the next term, breach of contract. I'm sure you got this. A breach of contract occurs when one or more parties fail to fulfill their agreed-upon obligations, effectively breaking the terms of the agreement. Let's see another one. Blind offer. Take a few seconds and decode it. A blind offer in real estate refers to a purchase contract made by a buyer without actually viewing the property. This unique approach bypasses time-consuming steps like inspections and appraisals, making the buying process quick and efficient for both buyers and sellers. Sometimes love at first sight works out, even when it comes to real estate. Another term on deck: closing. Closing marks the finish line in a real estate deal, where the official transfer of ownership and payment occurs between the involved parties, taking place once a purchase agreement has been signed and the title is ready for its new owner. Closing signifies the successful conclusion of the transaction. Closing cost. Now, based on the definition of closing, what could closing cost mean? Closing costs are the one-time administrative expenses incurred during the finalization of a mortgage, typically amounting from 2% to 5% of the home's purchase price. These costs comprise various fees needed to close the loan, such as loan fees, origination fees, title fees, prepaid taxes, attorney fees, and more, ensuring all the I's are dotted and the T's are crossed. Switching gears to the next word, liquidity. Go ahead, think about it for a couple seconds. Liquidity refers to the time it takes to sell an asset, and convert it into cash. Essentially, how quickly you can transform your investment into spendable money. Next up is loan. A loan is the sum of money you borrow to finance a property purchase. It's a common financial tool many individuals rely on for significant investments such as student loans, mortgages, or car loans, making those important life milestones more achievable. Loan commitment. Ready to take a guess? Let's do this. A loan commitment is an official letter from a financial institution, like a bank or credit union, promising to provide a loan to a borrower. This document outlines the loan's rates and terms, serving as a guarantee that the lender will grant the requested credit according to the agreement. Next term, let's get it. Ownership. Let's see if you can nail this. In real estate, ownership refers to the legal right of possessing a property, granting control and responsibility for its use and maintenance. You're becoming a definition mastermind. Wow! Next up is ownership in severalty. Take a stab at this term's meaning. Go! Ownership in severalty signifies a property ownership structure where a single individual holds rights and responsibilities over the asset. Trust. Go ahead and think about this term for a few seconds. A trust is like a three-person dance. The truster, who gives away the property, the trustee, who manages it, and the beneficiary, who reaps the benefits. Getting to the light at the end of the tunnel, our next term is trustee. Give it your best shot. A trustee is the responsible party appointed to manage a trust, ensuring that it's handled according to the truster's desires while prioritizing the beneficiary's well-being. This role can be filled by either an individual or a financial entity, like a bank. Open listing. Take your time and come up with the definition here. An open listing is a real estate arrangement that allows property owners to sell their home independently or with the assistance of several real estate agents. In this non-exclusive setup, the seller isn't tied to a single agent, fostering competition among multiple agents vying to secure a buyer and earn a commission. Here comes an easy one, just for you. Real estate. All right, how would you define real estate? Real estate is a term that refers to various properties and buildings, encompassing a broad range of assets and investments within the housing and commercial markets. The realm of real estate encompasses diverse property types such as residential homes, sprawling commercial complexes, undeveloped land, and industrial facilities, showcasing its vast scope within the property market. And the little sister of real estate is real estate agent. Put on your thinking caps. What's this term all about? A real estate agent is a qualified professional who has successfully completed the necessary real estate courses and licensing exams, within their state, equipping them with the expertise to assist clients in various property transactions. And here comes their little brother, real estate broker. A real estate broker serves as a crucial link between real estate buyers and sellers. They can operate independently or manage other agents. The key distinction between a broker and an agent lies in their ability to work autonomously. A broker can run their own business, while an agent must operate under a licensed broker. Obtaining a broker's license entails a separate process from acquiring a standard real estate license. Void contract. Take a few seconds and give it your best shot. A void contract is a flawed agreement, missing one or more essential components of a valid contract. Deemed invalid from its inception, this type of contract holds no legal enforceability. Think of a 17-year-old trying to buy property. They enter into a contract with a real estate agent. That is a void contract, as the minor's legal inability to enter into such an agreement invalidates it from the very beginning. Now that you have decoded what void contract means, let's see if you can crack voidable contract. A voidable contract is a legal agreement that seems valid and enforceable, but can be nullified by one of the involved parties. Despite initially possessing the essential elements for enforcement, this type of contract may be revoked if significant defects or issues are later uncovered. Imagine a contract for a property sale containing an error in the property's square footage. The agreement seems valid initially, but upon discovering the mistake, one party could choose to void a contract because the discrepancy impacts the property's value. Unlike a void contract, this agreement was initially considered valid until the issue was uncovered. Drumroll! Inspection contingency. Let's see if you can nail this strange definition. An inspection contingency is a safety net for home buyers, allowing them to address any unexpected issues uncovered during a property inspection. In such cases, the buyer has the option to ask for repairs, negotiate compensation, or even walk away from the deal, because sometimes what you see isn't what you get. Property tax. Take a few seconds and crack this term. Property tax is essentially a fee that property owners pay to their local government. Calculated as an ad valorem tax, it's based on the value of the owned property. Think of it as a way for local governments to maintain and improve communities, all while you enjoy the benefits of owning a piece of real estate. Let's jump straight to the next term. Net listing. Guess what net listing means? In a net listing, the seller and agent team up to make the most of a property sale. The seller sets a minimum asking price and lets the agent work their magic. If the agent manages to sell the property above the price, they get to keep the difference as a commission. Say a seller sets a minimum price of $500,000 for their house with a net listing. The agent sells it for $550,000. The agent earns a commission of $50,000, which is the difference between the selling price and the minimum price. It's a win-win situation where both parties benefit from a successful sale. Gear up for the next one. Net operating income. Net operating income is the money a property brings in after subtracting all those frustrating operating expenses. It's a snapshot of a property's financial health and profitability, helping investors decide if it's worth their time and money. Time to explore another term. Net lease. Ready to take a guess? Let's do this. A net lease is a rental agreement where the tenant pays rent and additional property expenses like taxes, insurance, and maintenance. This structure exposes tenants to property ownership responsibilities without actual ownership. Sole proprietorship. Let's see if you can nail this definition. A sole proprietorship is a one-person show where an individual or married couple owns and runs the business. As the most popular model for real estate agents, it's like being your own boss, where you and your business are one entity. Simple, flexible, and empowering. Here comes another one. Tie-in agreement. Give it your best shot. What's this term about? A tie-in agreement connects two products or services, requiring the buyer to purchase both together. In real estate, this could mean agreeing to use a specific lender or service provider as a condition of the sale. While it may offer benefits or discounts, buyers should carefully consider the terms and potential implications of such agreement. Here comes a well-known couple. Subletting. What does subletting really mean? Ever played musical chairs but with apartments? Subletting is the real estate version. When a tenant needs to exit their lease early, they find a replacement tenant to step up in their rental agreement with the landlord. It's a strategic solution that keeps the lease alive and ensures everyone has a seat, or rather, a place to call home. Alright, how about subleasing? Subleasing is when a tenant rents part or all of their lease space to another person while remaining responsible for the original lease. It's like being a mini landlord within your own rental, providing a flexible solution for tenants with extra space or temporary changes in their living situation. Always consult your lease and local laws before entering a sublet agreement. Receivership. Can you decode this peculiar term on the spot? Receivership is a legal process where a court or lender appoints a receiver to recover funds from a borrower in default. This helps protect the value of the property while ensuring the lender's interests are met. In real estate, receivership can provide an orderly resolution when a borrower struggles to meet their financial obligations. Can you remember the definition of property manager? If you do, that will come in handy now. The next term is property management. Take a few seconds and think about it. Property management involves supervising real estate assets, ensuring smooth operations, and maintaining their value for owners and tenants. It's a vital service that keeps properties in top shape and financially viable. Moving on, creative financing. You got this. Let's go. Creative financing is an innovative approach to securing funding for real estate investments without relying on traditional lending methods. Investors use unique strategies and techniques to acquire the capital necessary for their purchases, enabling them to think outside the box when financing their projects. Mezzanine financing. Put your definition skills to the test. Mezzanine financing blends debt and equity financing, offering an alternative funding source for real estate projects. It serves as a middle ground between senior debt and equity, providing additional capital while giving lenders a lower priority in repayment compared to senior lenders. For instance, let's say a developer is constructing a 20 million luxury apartment complex, but has only secured a 15 million senior loan. Mezzanine financing could cover the remaining $5 million while accepting a secondary repayment position. Kickback. 5, 4, 3, 2, 1, go! A kickback in real estate occurs when an agent accepts financial incentives or valuable items for referring clients to a particular business or service. This controversial and illegal practice involves sharing a portion of the profits generated from referrals with the agent who facilitated the connection, raising ethical concerns within the industry. Ready for the next? Good! There you go, the Fair Housing Act. The Fair Housing Act is a crucial federal law ensuring equal access to housing opportunities by preventing discrimination in buying, selling, renting, or financing homes. Protecting individuals based on race, religion, sex, disability, familial status, and other factors, this legislation promotes a fair and inclusive environment for all seeking a place to call home. And the Fair Housing Act goes hand in hand with the Fair Housing Amendments Act of 1988. The Fair Housing Amendments Act, FHAA, strengthens the Fair Housing Act by extending protection to families with children and individuals with disabilities. Enacted in 1988, this legislation fortifies the fight against housing discrimination. Onward to the next term. Tax lien. Your turn to be the definition guru. A tax lien is a legal claim imposed on a property due to unpaid real estate taxes, ensuring the government's interest in the property until the outstanding debt is settled. Sticking with the definitions relating to tax, here is another one: tax rate. Think you know it? Give it a shot. A tax rate represents the specific percentage levied by the government on individuals, businesses, or other entities, determining how much they must contribute to the public coffers. Next up is taxation. I'm sure you know this. Taxation is the practice of collecting a share of value from individuals or businesses to fund and support public welfare. Easy, right? Let's see the next term on our list. It is none other than principle of progression. Give it a go and decode it. The principle of progression highlights that a property's value tends to rise when higher value developments emerge in its vicinity, reflecting the influence of neighborhood improvements on real estate worth. Here comes the misbehaving little brother of principle of progression, principle of regression. The principle of regression posits that a property's value may decline when lower value developments are introduced in its surrounding area, reflecting the impact of neighborhood changes on real estate worth. Valid contract. Again, it's time to play Guess the Term. A valid contract is a legally binding agreement that fulfills all court-defined criteria, ensuring enforceability under the law. Next term activate. Grant. Think you know it? Let's see. The legal transfer of real property ownership from the seller to the buyer via a title exchange. Speaking of a grant, next up is grantee. The lucky recipient who gets to call themselves the new legal owner in a real estate transaction. All right, let's keep the momentum going. Here's another one, grantor. The legal term for the seller in a real estate transaction. Now let's look at another important concept: Environmental Protection Agency, or EPA. The Environmental Protection Agency, EPA, is a federal organization that oversees and addresses environmental concerns. Established in 1970 by President Nixon's executive order, the EPA plays a vital role in preserving the health of our environment. Ready to conquer the next term? Deed. But what does deed mean? A deed serves as a written legal instrument that officially transfers real estate ownership from one party to another, documenting the transaction for legal and public records. Now that you know what deed is, let's see if you can nail deed restrictions. Deed restrictions define legally binding limitations on property usage set by past or current owners that typically remain in place indefinitely, shaping the property's present and future development. Imagine, in a suburban neighborhood, a homeowners association enforces a deed restriction limiting house colors to neutral shades. This preserves the community's aesthetic and maintains property values over time. Fasten your seatbelt, here comes another term: subsidized housing. Subsidized housing offers government-supported financial aid for housing to low-income individuals and families, often referred to as affordable housing in the United States. This program aims to ensure access to safe and affordable living spaces for those in need. Close to the finish line of this round. Next up is zoning. Take a few seconds and think about it. Zoning involves local government rules for public land use and development. These laws determine what real property can or cannot be used for in designated areas, significantly impacting community growth and land preservation. Next term, let's get it. Zoning ordinances. Go ahead, take a guess. You've got this. Zoning ordinances serve as the rulebook for determining how properties, most often land, should be used and developed within specific zones. Consider them the referee, ensuring that land use plays well with community needs, goals, and the spirit of local planning. Freehold estate. Take a few seconds and think about the definition. A freehold estate is like owning a property outright, forever. You get to enjoy all the benefits and rights of owning that property without any time limitations. It's different from a leasehold estate where you have the property only for a specific period. Next turn, let's go for it. Effective age. Take a crack at it. You've got this. Effective age is all about how old a property seems, not its actual age. It's determined by things like its condition and how much it's been used. Appraisers consider effective age when figuring out the fair market value of a property, making it a crucial appraisal concept. Time for another term. Easement. Guess what easement means? An easement is like having a golden ticket to use someone else's land for a specific reason. For instance, driving through their property to reach yours. Think of it as a friendly agreement between neighbors that lets you legally use a part of their land without owning it. Let's jump to the next one. Easement by necessity. An easement by necessity is a special type of easement created by courts to ensure you can access one part of your land by going through another part. It's similar to an implied easement and is only granted when absolutely necessary for you to make proper use of your land. Moving on, easement in gross. Can you decode this strange term on the spot? An easement in gross is a unique type of easement that's tied to a person or entity, not a specific property. It gives an individual the right to use the land, but it doesn't stick around if the property is sold. Unlike regular easements that stay with the land, an easement in gross is all about who gets to use it. Another one is on the horizon. Dominant estate. 3, 2, 1, go! A dominant estate is like the cool kid in the neighborhood who gets to use someone else's property through an easement. Think of it as the property that gets special privileges, like having a private shortcut through another piece of land. It's the one that benefits from the easement. Next term, let's get it. Appraisal. An appraisal is a professional evaluation that estimates the value of a property. It's a crucial step in determining how much a property is worth in the current market. Now that you know what appraisal means, let's see who an appraiser is. Take a few seconds and come up with your definition. An appraiser is like a detective for property values. With their expertise and license, they can accurately assess a property's worth and report their findings. All right, what's next on the turn train? Cost approach. The cost approach is an appraisal method that's all about figuring out how much it would cost to replace a property. It's like estimating the price of a puzzle. You consider the value of the land, aka the puzzle's frame, and the construction cost, aka the puzzle's pieces. Then subtract depreciation, aka wear and tear. For example, if a house is built for $200,000 on a $50,000 lot, the cost approach would value it around $250,000 minus any depreciation. You got this. Unleash your inner definition guru. Appraisal contingency. An appraisal contingency lets buyers back out if the property appraises below the agreed price. Banks often require appraisals to ensure the house's value matches the offer, protecting buyers and lenders from overpaying. It's a safety measure against financial loss. Bravo! Here comes another one. Lot and block. Lot and block is an appraisal method used in densely populated areas like cities and suburbs. It involves taking a large, already surveyed tract of land and dividing it into smaller lots. A map is then created to outline the smaller lots within the larger area. Think of it as creating a smaller puzzle from a bigger one, making it easier to organize and value each piece of land. Quick, think on your feet. The next term is offer. An offer is a proposal made by one party to another, laying out the terms and conditions under which they are willing to enter a contract. It's like extending a hand for a handshake, but with a bit more paperwork involved. Counteroffer. Take a moment. Can you nail this definition? A counteroffer is a response to an initial offer that suggests different terms or conditions. It's like saying, "Thanks for the offer, but let's try this instead," effectively replacing the original offer with a new proposal. Switching gears to the next term, buffer zone. What does buffer zone mean? A buffer zone is a land area between two different use districts, like parks or highways. Its purpose is to create a smooth transition between zones, making it easier to go from one area to another. Moving on to air rights. Put your rational hat on. What are the air rights? Air rights grant permission to use the space above the earth, like building skyscrapers or operating aircraft. Simply put, they are the rights to use the sky. All right, time for a new challenge. Agreement of sale. An agreement of sale is a document that outlines the terms and conditions under which a buyer agrees to purchase a property, and the seller agrees to sell it. On to the next term, acceptance. Think you know it? Give it a shot. Acceptance is the moment when the seller agrees to the buyer's offer in a real estate transaction. Once accepted, the offer transforms into a binding contract, sealing the deal between both parties. Consider it the "I do" in the agreement of sale. Next term, let's get it. Novation. Ready to take a guess? Go for it! Novation is the process of ending an existing contract and creating a new one in its place. This legal procedure transfers all the contract's benefits and responsibilities from the original parties to the new ones. For example, if a tenant finds someone to take over their lease, novation can be used to transfer the lease obligations to the new tenant. Think of it as a contract makeover, maintaining the original essence while introducing new participants. Leaseback. Brace yourself. It's a term-defining moment. A leaseback is a financial arrangement where a company sells its property and then leases it back from the new owner. In this transaction, the seller becomes the new tenant and the buyer takes on the role of the landlord. It's like hitting a reset button on property ownership while still enjoying its use. Let's conquer the next term, lease termination. Got a hunch? Bet you do. Lease termination happens when either the landlord or tenant decides to end the rental agreement before its original end date. Though not usually permitted, there are specific situations where terminating a lease early is acceptable. Lease option. Stretch those definition muscles. You can do this. A lease option or rent-to-own agreement is perfect for tenants who dream of owning the property they are renting. This agreement allows renters to purchase the property after a predetermined rental period, combining the benefits of renting and owning into one attractive package. It's like test driving a property before making the big commitment to buying it. Let's tackle the next one, lease expiration. What's this term about? Lease expiration marks the end of the rental agreement's lifespan, signaling the termination of the contractual bond between landlord and tenant. When a lease reaches its expiration date, the terms and conditions of the lease are no longer enforceable. All right, what's left? Implied grant. Implied grants are like unspoken agreements that create easements based on circumstances or behavior. For instance, when you sell a house, in your backyard, it is implied that the buyer will need to use your driveway or access road to reach the road since both properties were in common ownership. Implied contract. Let's see what implied contract means. An implied contract is a legally binding agreement based on actions, conduct, or circumstances, even though it's not explicitly stated in words. It carries the same weight as a written or verbal contract, but relies on unspoken understanding. For instance, if you regularly pay a neighbor to mow your lawn without a formal agreement, that's an implied contract in action. In a similar scenario, when a tenant pays rent monthly without a formal written lease, it suggests that they may have an implied month-to-month lease with the landlord. Next term, let's go. Fixture. Put on your thinking caps. What's fixture about? In real estate, a fixture is an item initially considered personal property, but becomes part of the real property when it's permanently attached or legally added to the land. Essentially, it's when personal items transform into real estate features due to their connection with the property. Contingent property. Go ahead, take a wild guess. A contingent property refers to a real estate transaction where an offer has been accepted, but the deal relies on one or more specific conditions being fulfilled before the sale can be completed. It's a property sale with a built-in if-then scenario. Hang in there, we are getting close to the finish line. Financial contingency. A financial contingency is a safeguard in a real estate contract, allowing buyers to withdraw from a property sale if their loan application doesn't go as planned. It protects buyers when financial issues arise. Consideration. What's your take? 3, 2, 1, go! Consideration is the valuable item or service exchanged between parties in a contract, ensuring mutual benefit and serving as a key component of a legally binding agreement. It's the give and take in a contract. Blockbusting. Think fast. What blockbusting is? Blockbusting is an unfair tactic where homeowners are persuaded to sell their properties below market value due to a supposed decline in the neighborhood's desirability, often fueled by discriminatory beliefs about minorities moving in. It's a shameful practice that exploits prejudice for profit. Abutting. Ready, set, define. Abutting refers to properties or land areas that share a boundary, making them neighbors in the world of real estate. In simple terms, it's about being side by side. Redlining. Take a few seconds and think about it. Redlining is a discriminatory practice in which people, often based on their race, are unfairly denied services like loans or insurance. It originated when banks labeled certain areas as high risk on maps using the color red. Nowadays, redlining is illegal, ensuring a more inclusive real estate environment. Here comes another term: alienation clause. An alienation clause is a key agreement in real estate transactions. Simply put, it ensures borrowers fully pay off their mortgage before transferring or selling a property. Blanket mortgage. Let's see if you know what blanket mortgage means. Imagine buying several properties with just one mortgage. That's a blanket mortgage. This convenient loan type simplifies the process by bundling multiple properties under a single mortgage, saving you from juggling several loans at once. Delinquent mortgage. A delinquent mortgage occurs when a borrower misses payments outlined in their mortgage contract. It's crucial to stay on top of your payments and avoid delinquency. Think of it like keeping up with your Netflix subscription. You don't want to miss out on your favorite shows. Next up on the term train, collateral. Time to truly flex those definition muscles. Take a few seconds and then let's see the definition. Collateral is the valuable property you pledge as security for a loan, like your house in a mortgage. It's your lender's safety net, ensuring they will get their money back. Time for the next one, dual agency. Dual agency involves a single real estate agent, representing both parties in a transaction. This practice, however, is illegal in some states and discouraged in others due to the potential conflict of interest that may arise when an agent tries to balance the best interest of both clients simultaneously. Real estate license requirements. Real estate license requirements are the essential steps determined by each state that you must complete to become a licensed agent. Think of it as your personalized roadmap to a real estate career. We can't stop, we won't stop. Moving on, realtor, give it a shot. A realtor is a real estate agent who belongs to the National Association of Realtors. They follow a strict code of ethics and rules that set them apart from regular agents. While often used synonymously, real estate agents and realtors have distinct professional identities and responsibilities. Let's jump straight to the next one. Optionee. What's this term about? An optionee is the legal title for someone who obtains and holds an option in a contract. Optioner. Optioner refers to the party granting the option in the contract. Together, optionees and optioners make the contract game complete. Alright, what's next? Government power. Take a few seconds and think about the definition. Government power refers to a state's constitutional right and responsibility to create and uphold laws for public well-being. This includes ensuring citizens' health, safety, moral standards, and overall welfare are protected and maintained. An example of government power in real estate would be zoning laws that regulate land use and development. Zoning laws regulate land use, building codes, and safety measures to maintain the well-being of the community without requiring compensation. Here comes another one. Steering. Think you've got what steering is? Well, let's see. Steering is an unlawful practice where someone is pushed to buy or rent property in a particular area due to their race, religion, gender, familial status, or disability. For instance, a real estate agent suggesting a specific neighborhood to a client solely based on their race would be considered steering, which violates fair housing laws. Bring on the next term, blind ad. A blind ad is an anonymous advertisement that leaves out the advertiser's name or license status. Think of it as a masked message in the real estate world, lacking vital information for transparency and legality. Let's see another one. Capital gain. I'm sure you got this. Capital gain represents the profit earned from selling or auctioning property or investment, a key factor in real estate transactions. All right, how about capitalization? Capitalization involves transforming assets or income into capital, a process closely tied to maximizing property values. Capitalization rate. Cap rate or capitalization rate serves as an indicator of a property's potential return on investment, bringing these concepts full circle in the world of real estate finance. Another term on deck: exclusive right to sell listing. Go ahead, think about it for a couple seconds. In an inclusive right to sell listing, a single broker is appointed to represent the seller's property. This unique agreement ensures the broker earns a commission regardless of who ultimately sells the property during the contract period. Next up is exclusive agency listing. Picture a real estate agent specializing in selling cozy suburban homes. With an exclusive agency listing, the seller entrusts this agent to sell their property exclusively. The catch? The agent only earns a commission if they find the buyer themselves. And how about exclusive listing? An exclusive listing is a typical real estate arrangement, granting a single agent the sole right to sell a property. This contract ensures the agent is fairly compensated for their dedication and hard work throughout the selling process. Switching gears to the next word, commission. I'm pretty sure you are familiar with this one. Commission is the well-deserved fee agents earn upon completing a real estate transaction. Non-homogeneity. Ready to take a guess? Let's do this. Non-homogeneity refers to the distinctiveness found in a real estate development where homes differ in style and design. This lack of uniformity offers variety and uniqueness among multiple properties within the same area. Next term, let's get it. Adverse possession. Let's see if you can nail this. Adverse possession allows individuals who occupy a property without legal rights to gain ownership after an uninterrupted period, provided they didn't have the actual owner's permission, a legal process for establishing new property ownership. Bargain and sale deed. A bargain and sale deed shows the seller has ownership rights and can legally transfer property. But beware, it doesn't ensure the property is free from other claims or encumbrances. A typical scenario where you might encounter a bargain and sale deed is at property auctions, where buyers often acquire properties with limited knowledge of their history. Let's see the next one. Land trust. Take a stab at the meaning of land trust. Go! A land trust involves transferring property ownership to a trustee, safeguarding the property and granting legal protections, while ensuring the trustee manages it in the owner's best interests. Getting to the light at the end of the tunnel, our next term is Mrs. Murphy exemption. The Mrs. Murphy exemption allows owner-occupied homes with 4 or fewer rental units to bypass certain Fair Housing Act provisions, permitting property owners to discriminate against specific groups while seeking tenants. Corporeal property. Give it your best shot. Corporeal property signifies ownership of physical, tangible objects, basically anything you can see and touch, making it a significant aspect of personal property rights. Literal rights. Take your time and come up with the definition here. Consider a beachfront property owner. Their literal rights grant them ownership of the land, up to the water's edge, like a beach house with an ocean view, while the land beneath the water belongs to the government. Literal rights ensure landowners enjoy the benefits of their waterfront property. Here comes an easy one, just for you. Release clause. A release clause enables the release of a portion or the entire property from a mortgage claim, providing flexibility in managing and paying off mortgage obligations. All right, how would you define variance? A variance allows landowners to bypass existing zoning rules, providing an exception that lets them use their property in ways typically restricted by zoning ordinances. Drum roll, time for the last one. Executed contract. Put on your thinking caps. What is an executed contract? Imagine a real estate deal where the buyer and seller have signed a contract, fulfilled their obligations, and completed the transaction. This is an executed contract, a binding agreement where both parties have held up their end of the deal. Hooray!
You've done it! So you're well on your way of becoming a real estate vocabulary titan. And get ready for more adrenaline-pumping real estate knowledge as we continue this journey together. Please keep an eye on our next video and see you soon.